Imagine this. You're picturing yourself, maybe, in a stunning villa in Phuket. And yeah, remember it's pronounced Pooket, not Phuket. The sun is shining, there's maybe a gentle breeze coming through the tropical garden, and the ocean just stretches out endlessly before you. It's a dream for so many people, right? A real slice of paradise. But here's the thought that, often pops into our heads when we think about significant assets like that. What actually happens to that incredible property? Or maybe your other valuable holdings if you're no longer around? Okay, let's unpack this a bit. Today we're embarking on a deep dive into Thailand's inheritance tax. We're especially focusing on how it applies to foreigners. We've taken a really comprehensive look at the subject, and we're drawing heavily from an excellent article by Ocean Worldwide, their luxury real estate agency based right there in Phuket, been there since 2004, actually. So our mission today is to take what can seem like a really dense, complex legal landscape and distill it into clear, actionable insights for you.
We're going to try and cut through the jargon, get straight to the core of what you absolutely need to know, and hopefully help you feel informed and prepared for your own estate planning.
And that's exactly why this topic is so critical. This isn't just about, navigating a few tax forms. It's profoundly about securing your legacy and making sure that your loved ones don't face unexpected hurdles or, frankly, costly surprises during what is already going to be a difficult time. What's particularly striking, I think, is how often expats, maybe even those who've lived in Thailand for years, don't fully grasp the implications of these laws until it's unfortunately too late. We'll explore how Thailand's Inheritance Tax Act, BE 2058, that's the official name, which came into effect in 2016, basically created a structured system for taxing inherited wealth here.
Okay, it's always crucial to know the timeline for these things. Can you tell us a bit about the history of this tax? Like, when did this formal system really kick in?
Absolutely. So the law itself was announced back in August 2015, but it officially came into effect on February 1st, 2016. And that date, February 1st, 2016, it's a really crucial cutoff point. If an estate transfer process actually started before that date, it wouldn't fall under this new tax regime.
Okay.
But anything after that, yes, it's definitely subject to the rules we're discussing today.
Got it. So who exactly is covered by these rules? Is it just Thai citizens, or does it reach further than that?
Yeah, it has a pretty broad scope. It applies to both Thai citizens inheriting assets anywhere in the world, and it applies to foreigners inheriting assets specifically located within Thailand.
Okay, so definitely relevant for expats then.
Very much so. It's not just a local concern, which, brings us to a crucial question. What exactly counts as a taxable asset under this law? What are we talking about here?
Right. What kind of stuff falls under the net?
Well, it's quite comprehensive. It covers pretty much anything of monetary value that someone leaves behind in Thailand. And it's not solely about physical property, though that's obviously a significant concern for many expats owning, say, a condo. Taxable assets include things like real estate, so houses, apartments, land. Although, as we'll discuss, foreign ownership of land has specific nuances. Financial assets. This means your bank accounts here, shares in Thai companies, bonds, any other investments you might hold within Thailand,
Okay.
vehicles and valuables, cars, jewelry, art. If it's worth something and it's here, it's likely part of the estate calculation.
Right.
Business interests. If the deceased owned a stake in a Thai business, that value is also included. And, increasingly we're seeing digital assets like cryptocurrency or maybe online businesses become part of estates. That brings its own unique complexities under current Thai law, which is still kind of evolving in that area.
Interesting point about digital assets.
Yeah, the main takeaway is if it has a monetary value and it's located in Thailand, it's likely considered a taxable asset. Now, here's a really, really important figure. Thailand has a pretty generous 100 million baht exemption threshold.
Okay, 100 million baht.
Right. For direct heirs, that's your children, parents, or grandchildren, the first 100 million Thai baht is completely tax-free. That's roughly, 2.2 million pounds as of late 2023, give or take.
Wow, that is quite high.
It is.
Yeah.
So if the total inherited value is less than this 100 million baht, there's simply no inheritance tax at all for those direct heirs. Now, for heirs who aren't direct descendants or ascendants, think siblings, friends, partners, maybe that threshold is lower. It's 50 million baht for them.
Okay, still significant though.
Okay.
So putting that in perspective for many listeners, maybe those with more modest holdings, This could mean the inheritance tax might not even apply to their estate at all. That must be a significant relief for many.
Exactly. That's a huge point. This exemption significantly reduces the burden for many families, and it really does set Thailand apart from some other countries with much, much lower thresholds. Now, if the value of the inherited assets does go over that 100 million baht exemption for direct heirs, then the tax kicks in. But it's not a flat rate for everyone.
Okay, how does that work?
It's tiered based on the relationship. There's a 5% rate. This is for direct heirs, children, parents, grandchildren, but only on the value above the 100 million baht threshold.
Right, just on the excess amount.
Precisely. And then there's a 10% rate. This applies to all other beneficiaries, siblings, aunts, uncles, friends, non-married partners, again, only on the value above their threshold, which is usually 50 million baht, but sometimes depends on the specific situation.
Can you give us a quick example?
Sure. Let's say an estate is valued at 110 million baht, and the heir is a direct descendant, like a child. The first 100 million is tax-free.
Okay.
So only the remaining 10 million baht is taxed, and it's taxed at 5%. So the tax due would be 500,000 baht.
All right, that makes much clearer. That tiered approach certainly seems more favorable than maybe what some other nations impose. It's a definite advantage for families here. So let's zoom in now on the expat experience specifically. If you spent years building your life in Thailand, perhaps you own that dream villa in Phuket. How does your residency status here, or maybe lack thereof, actually affect things when it comes to this tax? What does this all boil down to for someone planning their estate, maybe from afar?
Yeah, your residency status does make a difference. If you're officially considered domiciled in Thailand, which basically means this is genuinely your long-term permanent home, often shown by things like a long-term visa or consistent residency over years, you're generally treated like a Thai national for assets within Thailand.
Fine.
This means if your total Thai estate value exceeds that 100 million baht threshold, it could potentially be taxed according to those rates we just discussed. But here's the really key distinction. Even if you're not a resident, maybe you just visit, but you own assets in Thailand, like a condominium or some shares in a Thai company, those specific assets are still liable for Thai inheritance tax if their value exceeds the exemption limit.
Ah, right.
So it really comes down to where the assets are physically located, not just where you permanently live day to day.
So if I'm getting this right, it's not just about where I live, but fundamentally about where my assets are situated. That feels like a crucial distinction many expats might overlook. They might assume their home country's rules always take precedence, right?
Precisely. That's a very common misconception. And another really critical element here is navigating potential double taxation.
Ah, yes. The dreaded double tax.
Exactly. Thailand has agreements, these double taxation treaties, with quite a few countries. They're specifically designed to prevent you or your heirs from being taxed twice on the same inheritance, once here in Thailand and again in your home country. It's absolutely vital to check if your home country has such a treaty with Thailand. You really need to look into that because these agreements can significantly reduce the overall tax bill.
How do they work generally?
Well, they often allow you to offset tax paid in one country against the tax due in the other. Or sometimes they might exempt the inheritance from tax in one of the countries altogether. It's a complex area for sure and depends on the specific treaty, but getting it right can save a substantial amount of money. Professional advice here is key. Okay, now let's talk about real estate and property inheritance specifics for foreigners, because honestly, this is where it often gets particularly intricate.
Yeah, I imagine property is a big one for expats.
It is, and Thai law has some very clear rules. Foreigners generally cannot directly own land in Thailand, full stop. This means if you, as a foreigner, inherit land, maybe from a Thai spouse or partner, you typically have to sell it within a year. You can't just register it in your name.
Right, I've heard that before. Sell within a year.
Exactly. Condominiums, however, are usually simpler. Foreigners can own condos directly, so inheriting one is often more straightforward, provided the foreign ownership quota in that particular building hasn't been exceeded.
What's that quote again?
Usually, it caps foreign ownership at 49% of the total saleable area in the condo building. If it's full, even if you inherit a unit, you might not be able to register it in your name and could be forced to sell, similar to the land situation.
Okay, so even with condos, there's a potential hurdle.
There can be. And then there are leasehold agreements. These are incredibly common for foreigners in Thailand, especially for houses built on land they don't own. You lease the land, often for 30 years, maybe with renewal options.
Mm-hmm.
Now, while a leasehold interest can technically be passed on, it's not always a simple handoff. The absolutely crucial detail lies in the specific wording of the lease agreement itself. Many leases have clauses stating exactly what happens upon the leaseholder's death. Some might require the inheritor to meet new conditions, pay fees, or in some unfortunate cases, the lease could even terminate upon death.
Wow, terminate. So your heirs could lose the property rights entirely.
It's possible, depending on the contract. This makes having a clear, well-drafted tie will absolutely vital. You need to specify your intentions for that leasehold, and your lawyer needs to ensure the lease itself allows for inheritance in a way that protects your heirs. Which, naturally leads us to think about how these complexities actually play out in real-life scenarios.
Yes, exactly. You've hit on something vital there. These legal nuances can sound a bit abstract until we apply them to actual situations. Let's maybe look at some scenarios. I think these came from the Ocean Worldwide article we looked at.
That's right.
Okay, first, let's consider Sarah. She's a British national, and she inherits land up in Chiang Mai from her Thai husband. Now, as a spouse, she's exempt from inheritance tax. That's good news for her.
Spousal exemption.
But because she's not a Thai citizen, she cannot actually register the land in her own name. So she's faced with that specific challenge. She must sell that inherited land within 1 year. It's a perfect illustration of those foreign land ownership restrictions in action.
A very common situation.
Then we have David. He's South African, and he inherits a condominium down in Phuket from his German partner, Anna. Now, here's the critical detail. They weren't legally married.
Ah, okay.
Because of this, David isn't exempt from inheritance tax. He'd likely face the 10% tax rate on any value exceeding the threshold.
Right, the non-direct heir rate.
Exactly. And to complicate matters further, the condo unit is in a building where that 49% foreign ownership quota is already full.
Oh.
Yeah. So this means David can't register the condo in his name either, even though it's a condo, not land. He must sell it. So now he's juggling tax implications and needing to find a buyer, likely needing both a Thai inheritance lawyer and maybe a specialist in cross-border succession to navigate it all.
That really highlights the multiple layers of complexity.
It does. And one more. Olivia, a Canadian expat. She inherits an online business and also some cryptocurrency from her brother. This scenario just spotlights the emerging challenges with digital assets under Thai law, which, as you said, can be less defined.
Absolutely.
Olivia will definitely need specialists, probably in digital asset law, maybe tech forensics too, just to help her prove ownership, gain access to digital wallets, figure out valuations, and manage the transfer procedures under both Thai and potentially international rules. These real-life stories really hammer home why understanding these laws and, honestly, getting the right professional advice early on is just so important.
Couldn't agree more.
Okay, so we've mapped out the broad landscape, who's covered, what's covered, the unique challenges, particularly around property. But, understanding the rules is only half the battle, isn't it?
Pretty much, yeah.
Now, let's get into the really tangible steps.
Yeah.
How exactly do you calculate this tax, and what's the actual real-world paperwork involved?
Right, let's get practical. First, for calculating the Thailand property inheritance tax, remember the value isn't just what you paid for it ages ago or even what you think it's worth today. The Thai Revenue Department uses the official appraised value. This is determined by government-approved valuers, and that's the figure that forms the basis for any tax calculation.
Okay, official appraisal, got it.
Then, to determine the net value of the inherited assets, you basically add up the appraised value of everything, a property, bank accounts, investments, other valuables, and then you subtract any liabilities the deceased had.
Liabilities
Like outstanding loans, unpaid bills, credit card debt, even reasonable funeral expenses can usually be deducted. The resulting figure, assets minus liabilities, is the net inherited value. And that's the number that gets compared against that tax-free threshold we talked about, the 100 million baht for direct heirs.
Okay, so it's the net value that matters.
Precisely. And as we mentioned, the calculation then depends on the heirs' relationship. For direct heirs, children, parents, grandchildren, it's a 5% tax rate, but only on the value exceeding the 100 million baht threshold. For everyone else, siblings, nieces, friends, non-married partners, it's generally a 10% tax rate, again, applied only to the value above their applicable threshold. Often 50 million baht, but check specifics.
Can you run through those numbers again quickly? Say 135 million baht inheritance for a child.
Sure. So 135 million baht total net value for a direct heir. The first 100 million is tax-free.
Right.
That leaves 35 million baht subject to tax. At the 5% rate for direct heirs, that's 1.75 million baht in tax due.
And if it was a friend inheriting that same amount?
If it were a non-direct heir, like a friend, they'd likely have the 50 million baht threshold. So 135 million minus 50 million leaves 85 million taxable. At the 10% rate, that would be 8.5 million baht in tax. Quite a difference.
Definitely highlights the benefit for close family.
Yeah.
What about other exemptions or allowances?
Well, the biggest one is that sub 100 million baht threshold itself. If the estate's below that for direct heirs, no tax is payable at all. That's huge. Beyond that, there are the spousal exemptions. Surviving spouses are completely exempt from Thai inheritance tax, regardless of the estate value.
That's a major relief for spouses.
Absolutely. Also, assets left to government bodies, recognized charities, registered foundations, or religious organizations are typically tax exempt. This encourages philanthropic giving. And it's really worth highlighting again how these exemptions make Thailand's system quite welcoming for many inheritors, especially when you compare it to places like the UK, for example, where the threshold is much lower, around £500,000, I believe, currently, and the tax rate can jump up to a hefty 40%. Thailand's approach with the high threshold and lower 5–10% rates is objectively notably more favorable for many families.
Yeah, that comparison really does underscore how strategic planning in Thailand could potentially be far more beneficial than in some other regions.
Okay, so once you've hopefully grasped these favorable terms in the math, the next critical step is compliance, right? What happens after the inheritance becomes official in terms of deadlines and paperwork? Compliance is absolutely critical. You, as the heir receiving the assets, generally have a window of 150 days. That's 150 days from the moment you officially receive the inheritance or have it registered in your name to file your inheritance tax return with the Thai Revenue Department.
150 days. Okay, about 5 months.
Roughly, yes. And importantly, the deadline for paying any tax due is usually the same as your filing deadline, that 150-day mark. You typically file and pay together. It's crucial to stick to this.
What happens if you miss the deadline?
Well, penalties for late submission or late payment are definitely something you want to avoid. If you file your return late, you can expect fines and interest charges, which start adding up from the day after the deadline passed.
Yeah.
And if you're found to have underreported the value of assets or maybe provided incorrect information intentionally or not, that's treated much more seriously, that can lead to significantly higher fines, potentially double the tax owed plus surcharges, and maybe even legal action in severe cases. It's always, always better to be upfront, accurate, and proactive.
Makes sense. What about the documentation? What do you actually need to pull together for the filing?
You'll need to gather quite a bit of paperwork. It's best to start early. This typically includes proof of death. The official death certificate is essential. Identification. For yourself as the heir, passport, ID card, and similar ID for the deceased. Detailed asset documentation. This is often the biggest part. You'll need property deeds for any land or buildings, maybe in Phuket or elsewhere. Bank statements showing balances at the time of death, investment portfolio statements, vehicle registration documents, proof of ownership for any other valuable items, proof of relationship, things like birth certificates or marriage certificates to establish your connection to the deceased and determine the correct tax rate and threshold, valuation reports. As we discussed, especially for significant assets like property, you'll need those official appraisal reports to determine their taxable value.
Okay, that sounds like quite a checklist.
It can be. It really stresses the importance of being organized. And frankly, this is often where getting professional advice from a local lawyer or accountant is invaluable. They know exactly what's needed, can help gather it, ensure valuations are correct, and handle the filing properly, saving you potential headaches and costs down the line.
It certainly sounds like it could seem like a lot to manage, especially during a difficult time. But the good news, I suppose, is that there are definitely proactive ways to plan ahead. To minimize the potential tax burden for your loved ones, you can take steps now to secure your assets and ensure your wishes are followed smoothly.
Absolutely, yes. Proactive planning is key. One smart move to consider is utilizing trusts and foundations. These are legal structures that can hold assets on behalf of beneficiaries. By placing assets into a trust, for instance, they might, under certain circumstances, be removed from your personal estate for tax purposes. It's a way to manage property and ensure it's passed on according to your specific wishes, potentially lowering that final taxable amount. It needs careful setup, though.
Okay, trusts and foundations.
Yeah.
What else?
Another common strategy is gifting assets during your lifetime. By legally transferring ownership of, say, a property or some investments to your intended heirs before you pass away, you can effectively shrink the size of your taxable estate later on. This means there's less value for inheritance tax to be calculated on when the time comes. Of course, there are specific rules around gifting in Thailand, like gift tax implications above certain amounts per year, so it needs to be planned carefully with advice. It's not just a free-for-all transfer.
Right. Makes sense.
Or
Are there other tools?
yes, life insurance policies can play a really significant role in estate planning here. You can specifically take out a life insurance policy where the payout is intended to cover potential inheritance tax liabilities. This ensures your heirs receive funds directly from the insurance payout, which they can then use to pay any tax due without having to scramble or, worse, sell off other valuable assets like that family villa in Phuket just to cover the tax bill. It provides a crucial financial safety net and prevents a forced, potentially undervalued sale.
That sounds like a very practical solution.
It can be very effective. And for expats in Thailand specifically, good estate planning really needs to consider both your international and your Thai assets. It's often very wise, maybe even necessary, to have separate wills. One specifically dealing with your Thai assets under Thai law, and another will covering assets you hold in your home country or elsewhere. This just simplifies the probate process for your beneficiaries and ensures compliance with the different legal systems.
So 2 wills, potentially.
Often, yes. And the importance of having a valid Thai will for your Thai assets cannot be overstated. Without one, your estate here will be distributed according to Thai intestacy laws. These are basically the government's default rules for dividing assets when someone dies without a will. And those rules might be very different from your personal wishes. They might prioritize certain relatives over others you intended to benefit.
So the state decides if you don't have a will.
Pretty much. A well-drafted Thai will appoints an executor you trust, and it specifies exactly how your assets, like property or bank accounts here, should be handled and distributed. If we connect this back to the bigger picture, all this proactive planning is really about achieving genuine peace of mind for yourself now and ensuring your legacy is handled exactly as you intend later. And one final point on planning. It's crucial to conduct regular reviews of your estate plans. Life isn't static, right? Laws change, your financial situation changes, family circumstances change, marriage, divorce, births, deaths.
Good point.
You should really revisit your will and your overall estate plan every few years, maybe every 3-5 years, or definitely after any major life event. This just ensures your plan remains relevant, up-to-date, and effective for your current situation.
That's really solid advice. So thinking back to our starting point, what happens to your beloved property in Phuket or your other assets here in Thailand? Ultimately, it seems it really comes down to the overall value of your estate located here. Thailand's inheritance tax does have that pretty generous 100 million baht exemption for direct heirs, which means, thankfully, many people won't actually have to pay anything. But if your total assets in Thailand, including maybe that beautiful villa, do go over that mark, then yes, tax could apply. And planning becomes essential. It's not about, sneakily avoiding responsibility, but simply about smart, informed preparation.
That's right. That's the perfect summary. The absolute key takeaway here is that planning ahead is your best strategy. A well-structured estate plan, definitely combined with a clear and legally recognized Thai will, can make a massive difference for your loved ones down the road. It smooths the entire process, reduces potential conflicts and stress during an already emotional time, and, most importantly, it ensures your wishes are followed exactly as you intended. So maybe the practical implication of all this, the question to leave listeners with is, what aspects of your estate planning are you going to review or maybe begin addressing this week now that you have these insights?
That's a powerful question to reflect on, definitely. And our advice on this deep dive would have to be, don't guess, and please don't delay this. Talk to a qualified local legal expert, someone who really understands the intricacies of Thai inheritance and property law to ensure everything is properly in order for your unique situation. It's truly about achieving clarity and providing care for your own future and, crucially, for the future of your family.